Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line Don Graves. Don's been a reverse mortgage specialist for as long as I've known him, for a very long time. And thanks for joining us today.
Hey, Mark, thank you so much. It's great to be here today.
So I know you've been a professor for the American College. You've been a practitioner in terms of offering reverse mortgages. How did you get into the business in the first place?
1999, I was president of a nonprofit in Philadelphia called Habitat for Humanity. And my sister called me and said, "Little brother, I want to run an idea by you." And she shared with me this idea. And I said, "Sis, out of all the things you've ever talked to me about, this one's going to land you in prison. Don't talk to me about it again." I said, "You're taking old people's houses. Our phones are probably tapped because of this." And Mark, I didn't touch it for a year. And and a year later, she said, "Little brother, you should look into this. You've got three little ones. You probably need some more money, but you have a heart to serve. You love people." And so I said, "Okay, I'll look into it." And I did. I talked to three representatives that were housing counselors: HUD, AARP, Fannie Mae, and the HUD Home Ownership Center, because I wanted to know the fine print, the gotcha, the aha. Because to me, a good name, the Book of Life says, is better than great riches. So I had to make sure that this
Right,
thing was on the up and up.
right. And so how long ago was that? How long have you been doing this for?
Oh, I'm in my 21st year now. That was 1999. I looked into it and jumped in 2000.
Wow, wow. And so you've seen all the highs and the lows of the market.
Oh,
Um,
sure.
yeah, so let's talk a little bit about reverse mortgages at a high level.
Okay.
Um, what's kind of the primary reason that people look at it and financial planners want to look at it for their clients?
It's the largest asset that most people, retirees, have. The U.S. Census Bureau said this, reaffirmed it in 2018, that average couple retiring today, age 65, has less than $100,000 saved, but a home worth around $200,000. So the single largest concentration of wealth and the asset portfolio of retirees is their housing wealth. So any advisor worth their salt that's doing any type of retirement income planning has to look at housing wealth if they're going to accomplish certain goals for their client. So it's just too big to be ignored.
Right. And you kind of taught me about the four buckets, right?
Yes, sir.
Income sources, you have insurance, right? You have investments, and then of
Mhm.
course, housing wealth, home equity. People don't really think of it as another source of their wealth, but as you pointed out, it's sometimes people's largest source of wealth.
Well, they don't think about it. I think every advisor understands it because you have clients who've had a 30-year mortgage, and they did that because they didn't have cash to buy their first house. And you've had clients who have a home equity line of credit, and they got that because they wanted to add on or go on a vacation or help their kids with college or do something like that and not raid their portfolio. You've had clients who've downsized. And so advisors are used to housing wealth in the general orbit of the conversation, but when we look at a particular senior friendly strategy, an equity release strategy that
Mhm.
allows them to convert a portion of their home's value into tax free dollars that don't require a monthly repayment, well, a whole world opens up. And particularly 42 retirement income planning strategies open up for advisors. And so
Right.
if we're looking at your client's income, their investments, their insurances, and those are the only three kind of buckets you have to work with. When you add housing wealth, and we begin to integrate, don't separate, integrate them, oh my
Mhm.
gosh, a world of opportunities opens up.
Right. And you kind of gave the definition there of what a reverse mortgage is. So tell us a little
Mhm.
bit about the criteria. You have to be at least 62 years old. What are the other criteria to be able to be eligible for the reverse mortgage?
Sure. The first reverse mortgage was 60 years ago. The federal reverse mortgage is 32 years old.
Hmm.
So it's a resource that allows those 62 years older to convert a portion of their home's value, turn it into tax-free dollars without the requirement of making a monthly mortgage payment. The amount of money you get is based off the age of the youngest borrower, the value of the home, and the interest rate. It must be a first mortgage, so any existing mortgages or loans have to be paid off first from the proceeds of the reverse mortgage. And finally, the loan gets repaid when the last surviving borrower permanently departs the house, moves, or deceases. At that time, whatever money mom and dad took was advanced to them, plus any accrued interest, gets repaid, and 100% of the remaining equity passes on to them in case they moved, or the heirs or their estate in case they deceased. And that's the basic premise of a reverse mortgage. And folks, four words, it's just a mortgage. If you can say that, it stops being spooky. No one is going to beat you up at the
Right.
barbecue if you remember it's just a mortgage.
Yeah, and people aren't afraid necessarily of mortgages, but this concept of reverse mortgages, all of a sudden, it kind of paralyzes them a little bit. So one of the reasons we do, this series, The Insurance Experts, is, when you're working with complex strategies, of course, you want to work with experts in this line of business. Of course, you're an expert. So what I wanted you to do today, if you're okay with it, is to share kind of a quick story, and we'll use that as kind of our guidepost to see how this actually works. And you'd mentioned a client that you recently worked with. Why don't you tell us a little bit about their objectives and how they were able to unlock the equity and solve a funding need that they had?
Sure. And the client I work with typically is the financial advisor, the insurance expert, and I become their case designer, their consultant. So this advisor was doing a review, speaking with the client. It happens all the time. And when you're doing that, you find some gaps in the plan, some concerns. And this particular client, as they were reviewing what they had a concern that they may not have enough to have a extended care plan to fund the out-of-pocket costs associated with long-term care. So as the advisor was saying, well, let's look at this, let's think about that, and right in front of them, and right in front of every advisor, 87% of retirees own a home. So they look down on the fact finder and says, well, we see you got a $450,000 home. You've got a mortgage payment of $1,700 a month, and that's going to happen for the next 23 years. And as they're looking at that, the thought is, well, if you've got a client, they've got a mortgage payment, they're already making dollars. But now they're saying, I've got a gap in my plan. It's an extended care. How do I fund it? And so the idea, because this person had read my book and been through the training I provide for advisors, says, if we're able to maybe get your payment from $1,700 a month down to $1,000 a month with a traditional refinance, would that be good? And they said, yes, then I'd have $700 more to work with. He says, well, what if we were able to get it down from $1,700 a month mandatory payment to zero? Would that be okay? And they said, wow, then we'd have $1,700 to work with. You see, he wasn't doing anything other than being a reasonable advisor and responsible advisor and talking about equity strategies. So they said, well, what's this one that allows us to get it to zero? He said, well, that's called a home equity conversion mortgage or the newly restructured reverse mortgage. It allows you to refinance, just like the first one we talked about. But with the reverse mortgage, you can refinance and choose whether or not to make payments or not. If you choose not to make payments, you've freed up $1,700, which you were paying out anyway. And that allowed the conversation to say, well, what could we do with that $1,700 a month? Well, maybe we can do a traditional long-term care insurance policy. They were medically eligible. Maybe we could do one of these life insurance policies that had an accelerated death benefit. Maybe we could do a combination of both, you see. But the point was, as the advisor was doing good planning, reasonable, in the best interest of the client, changing or looking at what to do with this monthly mortgage payment, refinance and make it lower, eliminate it and make it voluntary versus mandatory, was a very reasonable thing to do. So what they and then this just happened this last one, Mark. So I don't know the end of the story.
Yeah. Before you get into that aspect, let me take one step back. So there's obviously no free lunch in this world. How are they able to eliminate the payments? Obviously, they're using their home equity that's built up to this point to fund the ongoing payments. But what does that look like? I just kind of want to dig a little bit deeper into that.
So in this example, the client had a $450,000 home, and they were about, I think, 63, 64 years of age. So a reverse mortgage makes money available based off of the age of the youngest borrower, that's at the top, the value of the home, and the current interest rate. So for them, it made available about 185, let's just say $200,000. Well, their existing mortgage on there was $150,000 that they already had. So of the $200,000 the reverse mortgage made available, the first thing it did was paid off the $150,000 that they owed. So it eliminated that and it left them with $50,000 in a line of credit. So the first thing the reverse mortgage did is eliminate their existing mortgage payment, and it just replaced it. It replaced it with the reverse mortgage, which makes your payment, takes it from mandatory to voluntary. So they could still make a payment if they wanted, or they could use those payment dollars that they were making and reimagine them for some more planning opportunities.
And you're